Everyone's yelling 1929 is back, while stocks and real estate and other asset classes are sitting at relatively all time highs. So now the question is there going to be a crash or no crash? In this video, I'm going to show you the plan I use to both protect my assets and spot bargains. No doom scrolling required. So if you're looking for a calm and step-by-step plan of action, this is it. Let's jump in. As always, I would really appreciate it if you like and if you subscribe to my channel. All right, so let's talk about this 1929 chatter. As you all know, probably you've heard of this 1929 Great Depression stock market crash. Now, this was probably the worst period in history in the United States when it comes to the markets, the financial markets. Now, the reason why 1929 actually happened was because of a very multitude of factors that really all coalesced into this 1929 Great Depression. So let's take a look at this. Now, oftentimes, yes, historians, they do disagree as to the causes of the Great Depression. However, I thought this chart did a pretty good job in summarizing exactly what the different factors were, or at least the main factors that did actually cause the Great Depression. So let's check it out. First, I want to start with monetary policy. Now, monetary policy essentially focuses on anything, as you guessed, related to money. So here, government, which typically sets the monetary policy back then and even today, focused on a different approach with this monetary policy. So specifically, the Federal Reserve, which generally is the entity that sets monetary policy, kept interest rates really low during the 1920s. What does that mean? Well, if the interest rates are low, then that means the cost to borrow is also pretty low, right? And what does that mean? That means to increased loans. Why? Because there is lower risk. And why is there lower risk? Because the cost to borrow is pretty low. So all of that led to increased speculation because, again, people could take out loans much faster and it's easier for investors to borrow money. So when that bubble burst, the Fed actually raised the interest rates, and that ultimately made it really difficult for businesses, for people to pay it back because it ultimately costs so much money. So monetary policy, what they could have done differently is actually increase interest rates because they saw that there was so much activity, so much speculation going to kind of quell that, to slow that speculation down. The Fed could have increased just steadily interest rates to kind of slow that down and prevent from so much risk in the market through speculation. Next, tariffs. Now, what have we noticed with the recent government approach to tariffs? Well, there were some tariffs that were pretty high. Oftentimes, there's a tit for tat type of tariff that we have seen in the recent Trump 2 administration. But the point is, tariffs certainly weighed into the Great Depression. So overall, war debts also huge, specifically from World War I, right? And so there was about a 90% margin. Pretty high, if you ask me. Stock market crash and financial panic. Let's take a look at this. First and foremost, and I think this is one of the key reasons why the Great Depression actually happened, is because there were really weak safeguards, meaning there were no policies or restrictions in place to actually stop the stock market from trading further after a 15% decline, for example. This is actually a result of the 1929 depression and other further stock market crashes. Nowadays, this can't even happen anymore in our modern markets because there are certain safeguards in place. Like if in a trading day, the stock market decreases, I believe the number is 15% in one day, the stock market will be halted either by 30-minute intervals or completely. Why? So this drastic crash that didn't have these safeguards in place, like in the 1929 crash, that won't happen again. And when that crash happened, well, the automatic logical next step was bank run. So people were so worried about losing their money because either they were invested in the stock market or they thought banks, which were also quite heavily tied to the financial sector and the stock market, because guess what? Banks are focused in finance, that there would be bank runs. And bank runs is essentially when people run to the bank trying to get all of their cash out of the bank in the shortest amount of time. If that is a contagion, that is essentially what it is called, a contagion, which essentially is very similar to a virus where a ton of people all at the same time, they run to the bank to withdraw their money. The bank cannot sustain that. Why? Because banks only have really a certain amount of liquidity on them at all times, right? So in other words, I'm not just talking about physical cash. I'm talking about cash like up in the cloud or whatever you want to call it. But the point is, banks aren't always liquid, even though they are worth, several $billions. But to provide that liquidity, they would have to sell other assets that are currently tied up in the stock market, in real estate, or elsewhere. And if that happens, if this contagion happens, that can completely cause banks to crash, as we saw in 1929. And also, actually, Silicon Valley Bank, that was a very recent bank crash. SVB, you might remember that in, I believe it was 2023, where Silicon Valley had a lot of its assets tied up in the bond market, and the interest rates were fairly adverse to the current climate. Silicon Valley Bank was not very diverse when it came to the individuals that deposited. So the depositors for Silicon Valley Bank, they were typically all in the tech sector and in the VC space, right? Because Silicon Valley, as the name already suggests, was over in California. California in Silicon Valley has a lot of tech and venture capital. And well, guess what? Tech and venture capital had a slow run. And so the tech and venture capital firms, they wanted to, go and withdraw their money to pay their people. And it happened all at once. Also, there was some leakage that leaking. Silicon Valley Bank may have some issues. And thus the collapse started happening. I think it was from a Friday to a Monday. So very scary. But the FDIC, which is the Federal Depository Insurance Corporation, the FDIC protects individuals $250,000 in cash, $500,000 for joint accounts. The FDIC actually stepped in and essentially no one lost any money. So there are a lot of safeguards, and that was not the case back in 1929. So yeah, going very quickly to bank failures, the stock market crash led to widespread bank failures. Many banks had invested heavily in the stock market. So again, finance, just what we talked about. And when the market crashed, the banks were left with major losses. So those depositors, they were very panicked. They rushed to withdraw their money. And then that ultimately led to the bank runs. So the banks were unable to lend money. So that means there was no growth. Growth was kind of prohibited in the economy because banks were completely broke. And businesses were unable to get the credit that they needed to operate. So that means they had to let employees go. And that means more, jobless claims increased. So it was really a complete circle. And it all started because there were no safeguards, which again are in place nowadays. Farm crisis. There was a huge farm crisis in 1929 called the Dust Bowl. So as you can see, the Dust Bowl really affected the Midwest section here. Now, a lot of the food, at least at the time, and even nowadays too, came from the Midwest. And at the time, there was a dust bowl, which means that a lot of the states were affected by a severe dust storm, which essentially wiped out a lot of the food and the vegetation, the crops, and even the animals that most of America relied on. With the dust bowl in place and no food, there were massive food shortages. Well, guess what? The cost of food, if there's a low supply, the demand increases. And when the demand increases for something just like a Gucci bag, well, guess what? Gucci doesn't cost $5. Gucci costs like $10,000, if not more. Same thing happened here. There wasn't a lot of food supply at the time, thanks to the Dust Bowl, and so the cost of food went up like crazy. So all of these things, as you can start seeing, they coalesced from this monetary policy to high tariffs, the war debts. We got, really weak safeguards. We got the farm crisis. There was also a lot of overproduction. So in other words, in the 1920s, as you know, probably known as the Roaring Twenties, right? So there was a ton of excitement, speculation. This leads back to monetary policy because interest rates were low. There was a ton of construction in the automobile sector. Think of like the Model T Ford, right? There was a ton of construction with buildings, cities. Everything was booming. Everyone was roaring in the 20s, right? But as production increased, demand began to wane. That's the same thing, right? Think of the Gucci bag. If there's a lot of Gucci bags out there, every person has a Gucci bag. Well, guess what? Technically, the value would likely decrease. Now, I could counter this point too and say, well, guess what? Almost a large majority of the population has an iPhone, and yet, unfortunately, the cost of an iPhone hasn't decreased. But also, an iPhone is a lot more technologically advanced than a Gucci bag. But still, I mean, you could attack it from several points of view. But in any case, if there is a surplus, so if there are too many Gucci bags out there in the market, well, guess what? The prices will naturally fall at some point. They're not going to remain astronomically high. So that means profits will decline, which means businesses probably can't operate. Investors lose money. The economy, the confidence in the economy decreases, which again leads to a lower amount of money in the stock market. People are let go, and so on and so forth. Huge unequal distribution of the wealth. If you remember, if you had the chance to read The Great Gatsby, that is something that you can probably see and discern in the book. The presidential election in 1928, that was also just another factor for a lot of volatility that ultimately led to the 1929 stock market crash. So again, there was a lot of factors that were culminating, coming together, and then it was just like the perfect storm, no pun intended, because literally there was a perfect storm in the Midwest called the Dust Bowl. So what are some results here? So huge impact on the securities industry. So securities means essentially anything to do with the stock market. So very big impact there. Lots of regulation reform. And that's why chances are we're not going to be experiencing something similar to the 1929 crash in 2025 or 26. For example, the Securities Act of 1933. This was essentially, it provided companies, or it made companies provide full and fair disclosure of all information to investors. So companies couldn't just like be, they had to be very transparent. They couldn't just hide behind, these shutters and curtains and say, oh yeah, we're going to make you massive profits, but not actually explain how or what their processes are. So investors started to be protected from fraud and misinformation. Did it work all the time? No. Might I say Bernie Madoff, for example. But again, the point is, chances of fraud and misinformation from occurring certainly decreased thanks to the Securities Act of 1933. Next up, the Securities Change Act of 1934, a direct result from the 1929 crash. This enabled the SEC to regulate securities industry. So now all of a sudden there was oversight in the securities industry. Before there was no oversight. Like it was the Wild West, quite literally. Like anyone could do anything they wanted. They could market penny stocks. They could do anything without having to have a police. Like there was no one to police them. And if no one polices you, there are really high chances of fraud, misinformation, and people getting hurt, right? At least in the securities market. So these regulations, they now govern the securities market thanks to the SEC being the main regulator. Now we have FINRA, we have a couple of other regulators as well, but the SEC is the main one. So why is there actually this 1929 chatter now, right? Oftentimes that is the question. And, the answer is varied, but, the stock market has been sitting at a relatively high. The housing market has been pretty high. We've seen it in cities. It's maybe stalling in some cities because the owners of the house, they don't want to sell because they don't want to enter a relatively high interest rate environment in the housing market. But still, it's an appreciating asset nowadays, and all the time really, but especially nowadays. And crypto has been pretty high. Now we can say that arguably crypto has entered something like a crypto winter, but still relatively high, right? We're talking in the 5 figures, close to 6-figure area. And then finally gold, gold has also seen a high. It's now going a little bit lower. But the point is, there are a lot of these asset classes that have seen quite a bit of volatility, whether they're sitting at all-time highs or they have been and now are coming down. And ultimately, jobs is another really big one, specifically jobs that are impacted by AI. And I think AI really drives a lot of fear. So for example, some companies that have announced layoffs in 2025 goes from utility workers like UPS, or essentially, people that don't necessarily need, the internet, all the way to Amazon, to Bosch, to really big tech companies, Microsoft, even Apple just announced recently that they're going to cut dozens of sales teams and positions in a pretty rare layoff. And part of that, again, is driven by AI. In fact, some news releases say that 2025 has been one of the highest years where people were essentially let go. And that relates to 2008 and 1992, I believe. Those are the 2 other years that still surpassed 2025, along with COVID in 2020. So there is a lot of concern concern when it comes to these different factors. So now really the question again is this 1929? Is it a repeat? Because oftentimes people say, history might not be the same, but it certainly rhymes. So first of all, there's a lot of speculation, right? So like I just said, there's the AI hype. There's a lot of high prices, whether we're talking about real estate, whether we're talking about food, other things. The prices are very high, and that is sure. And it's even the salary for folks. Even salaries creep up. Why? Because of inflation. And then finally, productivity shifts. That is essentially driven by AI, right? So that causes job cuts, which is what we just saw. We also can see that there is a relatively high on the stock market for the S&P 500. So for example, in 1929, 1928, which is here shown in red, you could see that compared to the previous years or previous decade, which you can see here in red, the stock market just absolutely soared up to all-time highs, which you can see here, which then ultimately saw it drop to all-time lows, pretty much ever. And the S&P 500 now depicted in white, you can also see is essentially at all-time highs. And now people, overlap these two graphs, as you can see here, and they're worried, which, makes sense. Oftentimes you might know this drawing, right, where you have greed, where people say you want to buy more. And then when the stock market drops, that's fear, and that's when people want to sell, and you want to repeat that until broke. This is a very famous drawing by Carl Richards, the author of The Behavior Gap, and it just shows, people are very afraid of it dropping. And when the stock market does drop, that is when they end up selling and essentially locking in their losses and losing their money. So one thing I also wanted to share is this host, I believe from Squawk Box, Andrew Sorkin, on worrying similarities between Wall Street and the 1929 crash. So, not just individuals that are influencers or whatnot are saying this, but also, news sources like CBS, for instance, have mentioned the concern. So now the question is, what should you do actually? How do you stay ready to go and focus on your plan to make money and build wealth? The most important point that I want to bring across in today's video is just don't panic. Make sure you take a breath before tackling this plan, because ultimately it comes down to removing your emotion and to building a plan that you can implement at any time when you feel is ready. And that plan is what I call the STEADY framework, the STEADY framework. So, most important, this picture, I think, says it all. Ready, steady, go. It's not about panicking. It's about thinking through everything logically. So what does the S stand for? It means to shield your cash flow, your income, right? How do you do that? You want to build a mini emergency savings fund, maybe $2,000, maybe it's between 3 months of your overall living expenses. Ultimately, you need to do what is best for you. $2,000 is just a starting point. You also want to triage your debt. What do I mean by that? Anything that's over 10%, right? So if anything that is over 10% in interest rates, that is what you want to eliminate ASAP. Get rid of it, because assuming you do lose your job, because let's say it's another similarity to 1929 and jobless claims just keep on rising, well, you also want to make sure that, you have enough money for yourself to live actually and buy food and not have it all go toward 10% plus interest rates. You also want to do an audit of your bills. How much are you actually spending? You want to trim subscriptions, and you also want to trim any insurance that you have. Believe it or not, you can always probably, or at least most of the time, you can find insurance for your car, for your pet, for your house, etc. That's probably cheaper. Find comps, and always try to do this audit every 6 months or so is what I would say. And you can probably trim maybe about $100 a month or so across all of these platforms. I think that's absolutely doable. I was able to trim once, as an example, about $60 per month just from my Wi-Fi bill. And I called the Wi-Fi company. I told them about a comp I found online, and they lowered it to the comp. That was a big win. And it took me about, 25 minutes or so to get that done. It was a good saving. So subscription costs, I just wanted to show you how much money most folks actually spend on subscription costs, and it's quite surprising. Here you can see a difference between what people estimate they spend on subscriptions versus the actual reality of them spending on subscriptions. Their estimate is about $86 a month, and actually they spend $219 a month. That is massive. That's a massive amount. It's about like 2.5 times more, right? So quite a bit of money. On average, it says it right here. On average, consumers underestimate their monthly spend by $133, 2.5 times more than their original estimate. How much did consumers underestimate their monthly spending on subscriptions? You can see the difference here. But the point is, what this graph is showing is that people oftentimes, they don't realize how much they're spending on monthly subscriptions. And the main forgotten subscriptions is recurring monthly subscriptions. That's why there's so many recurring monthly subscription models out there, because those companies know that people like you and me oftentimes forget about them. And additionally, let's see, is there anything else? Millennials, unfortunately, are one of the higher groups. Gen Z is also one of the higher groups, right? So it doesn't surprise me that baby boomers are pretty cognizant. It doesn't surprise me that much that Gen Z is pretty cognizant, but both millennials and Gen Z, pretty much 50%, forget that they are still paying for subscriptions. So make sure you double check. Most forgotten types of subscriptions: mobile phone, internet, TV movie streaming. This is a big one, especially, if you have multiple TV movie streaming platforms. You got Amazon Prime, other subscription, digital, etc. So just make sure you do a quick inventory. All right, let's keep moving here because I want to make sure we get to the rest. The T is trim fragile risk. This means that you want to be very picky in what you invest. You want to avoid over leveraged debts. So that could be buying something on credit, right? Like with your credit card, or it could also mean buying a fund that uses a lot of debt to show performance. This is very risky, and you don't want that to be part of your actual core investing strategy. Ultimately, the rule of thumb that I would use is if rate resets, refinancing scares you, then you're investing in poor sleep well risk, because the goal is to always be able to sleep well at night, right? And you don't want to be investing in something like crypto, for example, that's extremely volatile, or some sort of crypto derivative strategy that might cause you to wake up in the middle of the night and worry if you still have your money. Focus on the core, pretty slow and pretty boring portfolio, because typically those are the ones in the long term that do decently well. The E in the steady framework focuses on expanding your income. So first we're protecting your income, your cash flow. Then we're getting rid of all of the debt. Now we're actually trying to build your income earning skills, right? So for example, ways to recession-proof your income is increasing your skills. That could mean getting an online certification. For some people, it means going back to school. Maybe their ROI is better if they go back to school and skip out 2 years of the recession while the economy is recovering and actually build up much more skills that they can have more money afterward. Or they build a side hustle, get some side cash going. Some quick wins, I just shared some quick examples. AI assisted freelance like editing, research, thumbnails. These are pretty quick and easy to do. Some local services, maybe you want to check your local listings and kind of get into your community that way. Apps, for example, there's TaskRabbit, Thumbtack, Neighbor. Neighbor is where you essentially upload, your space, whatever space you have. You could literally have a drawer or your driveway, and then people can store items in your drawer. They could store a vehicle in your driveway. This is really good, especially if you live in the city and you have a driveway and people are willing to pay like big bucks, like $500 or more a month, depending on where you live. So these are all good apps to kind of, to have in your back pocket and know that you can make extra money. The A in the steady framework is allocate quality core. So this goes back to our investing portfolio, specifically your core strategy. You want to keep a very boring, broad base. And you want to be focused on auto buy, right, through the cycle. So what does this mean? It means DCA, dollar cost averaging. That's what it means. Whether the stock market goes up, whether the stock market goes down, you keep buying, in this case, $15, I guess. Oh, yeah, no, sorry about that. You keep buying $100 each month, regardless of what the stock market does. So emotions are out of it. D in the steady framework is dry powder and discounts. So this here is how I grab discounts in the stock market. I do hold some cash. So this cash is in addition to the high yield savings account. So this here's anything in addition to. So I hold some cash in case of massive market dips. So I can buy the dip, right? So let's actually zoom out and go back to that drawing I showed you earlier from Carl Richards, right? So a lot of people, they sell when the stock market goes down. Well, the D in the steady framework, which is the dry powder piece, actually suggests that when the stock market goes down, you want to have that cash, right? So this here's your cash, and you actually want to inject it into the stock market at the low. And that is how you're going to make quite a bit of money when the stock market bounces back up. That is what the dry powder is about. You also want to make sure that you set buy levels in advance. In other words, when the stock market drops 10%, you are going to invest $1,000. Or when the stock market drops 20%, are you going to invest $2,000 or are you going to invest like $5,000, right? This is when you want to predetermine exactly how much you want to invest in advance. So you are acting and definitely not reacting. Why? Because reacting means emotions are involved, and we want to be like Spock. We do not want to involve our emotions, especially in such turbulent times. So the last piece of the steady framework is your edge, which is calm. That's the whole goal. Volatility really does transfer wealth from the emotional to the prepared. I've seen it as a wealth advisor in my 7 years. You want to pre-write the rules. So always pre-write rules. This goes back to what we just talked about. You want to act, not react. So you want to set those buy levels in advance. Know exactly what you're going to do before it actually happens. So finally, you want to spot some opportunities if you're curious about that without the fear of missing out, FOMO. I would kind of focus it on 3 distinct buckets. First, always have your core broad market bucket. This, for my portfolio, probably makes up about 80%. So I have a steady dollar cost averaging strategy, which we talked about. I ignore headlines. I don't look at what all of these news articles are saying. Obviously, I want to know what's going on in the stock market, but when they're saying sell, big crash happening, I ignore that. That's all noise to me. I focus on my strategy and I focus on what's boring and what works for me, which is typically a total stock market index fund. That's what works for me. Quality tilt. I have this for everything I buy, minus maybe the theme sandbox, but the quality tilt is really important. What does that mean? I look for companies that are relatively cash rich. They're trading below historical multiples. They've seen good growth, good profit over the years. They're blue chip, right? They're good companies. And then finally, the theme sandbox, which is a really small portion. I'd say this is between 5% to 20% of my portfolio. So these are more like thematic investments or ETFs like AI. Obviously, AI is pretty big. We've heard about it for the last 5 years consistently. Infrastructure, semiconductors is another really big one, especially post-COVID. And then cybersecurity, that one's becoming especially big, especially in relation to AI and a lot of those crimes that are happening. So those are some of the themes that I also want to invest in. But again, I do still try to incorporate the quality piece into the themes as well. So I want to make sure of all of these rather risky or riskier themes, I still want to make sure I incorporate quality. So 3 simple rules I follow. Number 1, never buy because it sounds cool. Like, oh yeah, AI sounds cool. Okay, yeah, it does. But why are you buying AI? Does it fit your plan? Do you have some play money or whatever you want to call it? You want to make sure that it always fits your plan, not because your neighbor's mom is buying it. If you do want to speculate, you want to buy one to sell one at the same time. In other words, it's one in, one out. So if you do really want to buy an AI thematic ETF, okay, what other risky ETF can you sell then in exchange for the AI one? So you're not over risky. And then finally, review quarterly. Don't do it daily. Don't be a CNBC news junkie. You don't want that. You want to focus on this in the long run. Again, ask yourself why you are investing. Chances are it's probably because of the future of retirement. So you want to focus the reviews on the long term too. And here's just a quick article on why we can't have another 1929. A lot of it focuses on the rules that we reviewed earlier with, preventing bank runs, that there was an SEC, there is now FDIC insurance to protect investors like in Silicon Valley Bank. There are circuit breakers that stop the stock market from trading, right? So to halt the panic. So there's a lot of safeguards in place versus in 1929. And it all happened, these safeguards are now in place thanks to 1929. So the most important thing to remember is, while yes, there certainly is volatility out there, and yes, chances are it could happen again, some sort of crash. Will it be a 1929? I mean, chances are probably not, just because there's so many things built into the system now to protect you, the investor, and to protect the companies as well. So the chances are really, really, really low. Hopefully this video helped you. Remember to start building wealth now. Follow my steps that I shared. And if you found this video helpful, please like this video and share it to help others, and subscribe to my YouTube channel. Remember, it's at _MMW for more cool insights, and join my newsletter for more exclusive tips. That is pinned in the description below. Your bank accounts will thank you later. Thanks.